Hello and welcome to your Global Markets Technical Outlook for the end of quarter 3 of 2025. Normal disclaimers apply as we get straight into it this time with the US stock market, and once again we're talking about all-time highs. Sitting there blasted straight through 6,000, and we've spent 3 full months above 6,000, so we have to say that is a confirmed breakout now, and looks like we're heading towards 7,000. Still very much in the center of this range of these parallel lines that have identified this very well-behaved uptrend that this market's been in all the way back from the end of the financial crisis in 2009. So always when we're at all-time highs, it does indicate that the market is probably going to be slightly overbought at those levels, and we'll see if that's going to make any difference this time around. But for now, it's up and away. On the weekly chart, we can very much see that breakout across past that old high there, and it's really looks like the market has actually been accelerating a little bit since then, almost going straight up in a straight line, and no sign of stopping yet. But you do have to say that these parabolic rises don't go on forever, and eventually we will see some turnaround in that. And it will probably come quite quickly as well, unexpectedly out of the blue. So just be aware of that as we inch towards these new all-time highs almost every week at the moment. On the Ichimoku chart, though, as you might expect, the market is clearly in bullish territory, just identifying that picture-perfect bounce of the cloud there that we saw back in April-May time. And that was really the sign that the market was taking off, and that broke through the old high and has continued on. Both the price, of course, and the Chiku span, both above the cloud, that indicates bullish territory, and we're now seeing that cloud support back there at that 5,500, so which is a very long way down from where the market is right now. So all looking very rosy and bullish on the price chart. Let's have a look now at the market internals and just see if that's all being backed up by what's going on behind the scenes. First one we're going to look at is the bullish percent index. Here we're sitting around about 59% of stocks bullish in the S&P 500. But as you can see, we're just starting to see these highs in the bullish percent index being coming in lower at each subsequent high in the market itself. So those heady days of peaks in the high 70s look like they're behind us now. And this kind of divergence that we're seeing in the indicator can go on for quite a few months before the market decides to take knowledge of it and break to the downside. But it does look like we're now in that area of shrinking participation in the number of stocks that are partaking in this incredible uptrend. Also, in the stocks above their 200-day moving average, we're also seeing that the peaks just starting to fall a little bit as the market makes new high. I guess this speaks to the participation of, or what's pulling the market up tends to be these the small group of large growth stocks, AI stocks, tech stocks, the Mag 7 and so on. Those are the ones that are really driving this market higher, and it seems that underlying that we're seeing a degrading of the rest of the cohort in the indexes. However, when we look at some other indicators, we don't see any of the same divergence happening. Discretionary versus staples is making a new high. That's agreeing with the market making a new high, so no indication of divergence there. Also with the semiconductors, as you might expect, of course, if the market's being driven by the AI story, there's a lot of demand for chips around at the moment. The chip makers are having a heyday. That's making new highs in this ratio here, and once again, that's agreeing with the index. So no sign of divergence there. Same on the advanced decline line. We're seeing new highs in this, so the advancers are outstripping the decliners. That is agreeing with the market high. So Divergence in a couple of places, but not across the board by any means, which means that, maybe things are just starting to degrade, but not to a point where we might see an imminent collapse just yet. And if we look at the performance year to date, we can see the NASDAQ is leading the charge, of course, as you might expect from having all those big growth stocks and AI stocks in it, up around 18%. S&P's in the middle, about 14, and the Russell small caps about 11 there. So that really does tell the story of this year. It's been very much driven by that AI story, and we're seeing that reflected in the tech-heavy NASDAQ leading the way. 18% is, of course, more or less double of what you would expect on average in terms of long-term return. So whether we see it finish up there or whether it has some pullback towards the end of the year to finish at a more reasonable amount, we'll have to just wait and see. Over now to the yield curve now, and you can see here we are definitely in that so-called normal shape where we have low rates of short-term maturities on the left-hand side and higher rates of those longer-term maturities on the right-hand side. And as you can see by the shadow lines there, it hasn't really changed much in the last few months. It's very much we are seeing the short end of the curve just dropping a little bit as the Fed funds rate is dropped there by the Federal Reserve, but otherwise the rates are very stable at the moment. However, it's worth bearing in mind that to get to this normal shape, we actually came out of an inverted pattern, and we can see that here on this next chart here, which looks at the spread between the 10-year and the 3-year. So just looking at the sort of left-hand side of that curve, and when the values drop below the zero line here, that's indicating the inversion here. And then earlier to the sort of start of this year, the inversion corrected itself and the line became normalized once again. It's just bouncing around that sort of zero line at the moment there, but the significance of that is because once we come out of this inversion and back into positive territory, that's almost always a forerunner for a recessionary period. This chart, which is kind of up the other way, if you like, shows the inversions at the top, so above the zero line in this case. And you can see in almost all cases past, each time we've had an inversion and then a correction back towards positive territory, it's been followed by one of these shaded areas, which are the recessionary periods. We're just in that. This chart's a little bit behind the times, but we are now back around about that zero line once again, which does indicate that we're probably looking at some sort of recessionary period, more likely than not, let's say, in the next 12 months or so. On the sentiment period, well, this really does indicate that the market is looking very overbought. The call ratio is way down into this so-called bullish extreme. This is where the amount of open call option contracts is outstripping the amount of put contracts by a factor of almost 2 to 1. So there's a lot of people far more bullish than there are bearish. Now, not much demand for portfolio insurance at this stage, and the result of spending any length of time in this bullish extreme is almost always some sort of corrective action in the index itself, as everybody gets to one side of the trade and there's no one left to buy, then we get a reversion to the downside in the market and the upside in this indicator. And we're just seeing a hint of it here. If we look at the 5-day moving average of the put-call ratio going back the last 15 years or so, every time it's dipped, well, not every time, but almost every time it's dipped below this 0.5 level, we have seen a correction come through marked by these red arrows. And just right at the end of the chart here, you can see we're just flirting with that 0.5 level once again. So perhaps we may not be too far off from some kind of correction in this market. On the volatility index, well, it's definitely established itself down in this low risk area since the Liberation Day tariff volatility episode. Things have quietened down a lot. A lot of the chaos and mayhem that we're seeing in the US politics at the moment is effectively priced in. And so we're not seeing any lurch to the upside in terms of volatility, despite the news feed that we're seeing at the moment. However, of course, it's always worth saying the VIX is a mean reverting index. So when it gets very low, it tends to balloon, and when it gets very high, it tends to collapse. So we should be on alert that at some point we will get another volatility event, and as we get towards these extreme all-time highs, the probability of that coming increases by the day. However, on the CNN's Fear and Greed Index, which is a composite sentiment indicator, we've moved from extreme greed, which is where we were the last time I did one of these roundups, to now into a more neutral area. And part of that is because we're seeing that decline in the market breadth that I showed earlier. But you can see here that it has sort of drifted down. So again, this is one of the indicators that perhaps gives us a little bit more cause for optimism that the market may not be about to collapse if people are being a little bit more careful with how they deploy their capital. But this does swing around. It's worth Googling that if you want to see the methodology behind it, because it actually uses quite a few indicators to feed into its end result. So with all that mixed messaging going on, I thought it might be worth reviving our infrequent Where to From Here series, where we can have a look at some of the other inputs that we don't generally have a look at. I found this chart interesting. This shows the forward PE ratios relative to the last 20 years. And you can see the current values of these little orange diamond shapes, and the range of the last 20 years are the vertical bars. And you can see that for a lot of them, we're well above the 90th percentile of what we would expect to find. So obviously, these valuations can't go on at that range forever. You would expect them to mean revert at some point. So buying to hold long term at this stage in the cycle, you're probably going to be buying a little bit overpriced. This is another way to cut that same or similar data. The price-earnings ratio, this left-hand chart here, basically is another way to look at what we've just seen on the other chart there. But the other interesting one is this one on the right here, which is the price-to-book value. And you can see that for the world and USA, we're way above where we would expect to be based on long-term averages of about 2.8. So we are definitely well overpriced in terms of the stock valuations at the moment. And just to sort of jump back to the yield curve, the other thing that's interesting is that not only is the yield curve gone from inverted to normal again, but it's starting to steepen. In other words, the shape of the curve is steepening. The left hand side is moving down, the right hand side or the right hand side moving up. And the last couple of occasions we had that large steepening in the yield curve, well, it was the last two major bear markets in the early 2000s, the tech wreck, and then, of course, the financial crisis in 2008. We're currently in a similar situation as we're heading up towards that area there. So we'll see if this may be one of the factors that precipitates that correction that we're expecting at some point. And speaking of recessions, well, if it wasn't for the spending that is being generated by the AI companies, then we may actually already have been in recession in the US. And one wonders how much longer these AI companies can spend billions of dollars on new data centers and purchasing chips and training models when most of them actually don't even turn a profit at this stage. So once that game is up, that could be the catalyst that sends the US economy into that recession finally. The other canary in the coal mine, of course, is the home builders in the US, which tend to be one of the first sectors to drop off prior to any recession as construction costs go up, labor costs go up, and so on. And we also start to see property development companies start to collapse as well. We're seeing a massive divergence, as you can see here, between the ratio of the home builders to the S&P 500 and the S&P 500 itself. Here we're seeing massive lower peaks while the market continues on higher. The other thing just on the home front is that home sales are starting to accelerate, or have been accelerating, in the US. And the last time we had a peak in that particular metric was back in August 2006, which was only a year or so before the stock market finally collapsed in 2007. And the reason why that's interesting is because the 18 or 18.5 year real estate cycle is actually coming in towards one of those cycle peaks at the moment. We're currently in this so-called winner's curse phase, which last ended in 2007, which predicts it should end around about 2025. That would take us into a cycle peak next year of 2026. So should we get some collapse or some big correction in the housing market, that would obviously also flow through to the rest of the economy, including the stock market. Having a look at the one-year seasonality now, and you can see that the low in the market came about a month after we expected it to appear according to the cycle. Since then, the market has been up and away. We didn't get any sort of correction in September. However, if the correction was low, does that mean the cycle is running behind or the market's running ahead? In which case, perhaps we should expect a correction sometime either at the end of this month or into November. Still looking fairly bullish towards the end of the year, of course. That's kind of highlighted by this chart here, which shows that we are now moving into the bullish quarter of the year. October, November, December, the group of 3 months that are the most bullish versus all the others. And onto the presidential cycle now. Once again, you can see here that the low in the cycle preceded the low in the market by about a month. Since then, we didn't quite get this peak, and once again, if we take the same angle of this line, that would put the peak somewhere towards the end of October and into November. So do we get the peak then, and then some sort of correction in towards the end of the year? That would be interesting to watch. And if we have a look at the big picture of the presidential cycle, you can see that the current market marked in red here and the cycle in black. As we get up towards the end of this year, you can see that the presidential cycle actually goes into a little bit of a sideways doldrums in towards these midterm elections, which are the end of next year in the US. So have we seen the best of what we can expect, and maybe next year will be a lot quieter? That's certainly possible, especially if we look at the 10-year cycle, the decade cycle, where we have just where we're just completing what the most bullish year of all the 10, which is year 5. But then year 6, as you can see, which would be 2026, looks a lot quieter and much more sideways. So perhaps we move into a bit more of a consolidation phase of this market. On now to the Australian stock market, and well, we're just dancing around up here at the 9,000 level. Who would have thought that we'd be up at 9,000 even just a few short months ago? This market's really taken off, and obviously well into all-time highs and making new all-time highs almost every week or month at the moment. And that 9,000 would obviously be a significant level if it was able to get across that and hold it. You have to say it's probably just looking a little bit overextended to the upside, but for now it's looking very strong after coming out of that correction earlier this year, and we'll see that a little bit clearer on the weekly chart here, where we got that pullback in towards those Liberation Day tariff announcements, and then from there we bounced out of that and we're almost up in a straight line towards that 9,000 level and just basically consolidating just under it. The breakout traders among you will know that this is a classic pattern that we're looking at here. Some sort of extended cup and handle at least, so we could see a move above that as long as everything else stays the same in the market conditions. Of course, no surprises that the Ichimoku cloud chart is also showing us that the market is very bullish with the Chiku span and the price both above the cloud, and the cloud support sitting round about that 7,900 at the moment. And comparing the ASX 200 performance this year with a bunch of other indexes, you can see it's the Hang Seng in the Asian markets that's really been leading the charge. It's been a very sort of boom-bust market, but it's up 34% for the year, which is an incredible amount for an index. The Nikkei bringing it up next to around about 20 for the year, which is also very good. And then we've got the S&P down about 14, the Aussie 200 about 8, and then the Indian Nifty 50 coming in about 5% for the year. On now to the currencies, and the US dollar is a weakening. We have it below this 100 level. 100 is obviously a key level on the dollar index. It's now spent almost 6 months below that 100 level. We're obviously seeing rates easing in the US. That's going to have a negative impact on the value of the dollar. But you have to also take that in the context of this. It's in this overall wider range of between 110 and 90. So it would be a surprise for it to see it break out of that larger range anytime soon. But unless it can recapture 100, then it's probably going to stay locked in this 90 to 100 area for a little while yet to come. And of course, a weakening dollar helps the other majors. Of course, here's the Aussie dollar moving up from that touch of the 60 area. It's now over 65 and does look like it wants to make a charge up to there to that 70 area. The cash rate in Australia is not falling nearly as fast as the one in the US, hence that differential giving the Aussie dollar a little bit of momentum to the upside. And the euro obviously making a little bit hay with the weakening dollar. It's moving back up from this 105 area back towards this 125 area, which is a key level. It does look like it's escaped this large descending triangle, although it's kind of just moved sideways. It's not really broken out to the upside, and that 125 remains the key level to the upside. The British pound's in a sort of similar pattern, but maybe not quite as bullish. It's just wiggling around here between this $1.20 and $1.45 area. And on the Japanese yen, well, it's weakening once again. It did find support around about this $0.0062 to the yen, but the bounce off there has not really been convincing, and it's, well, at best sideways and at worst falling back towards that $0.0062 level. But Bitcoin is making new all-time highs once again after getting itself across this $109.5 thousand level. It came back and found support at that level, and it's now made a new move into all-time highs from there, up just sitting at 123 at the moment, and it's just seems to be no stopping Bitcoin at the moment. And wrapping up on the commodities, well, crude oil continues to weaken. The $64 level was a key level. It made a sort of false breakout, if you like, down here, touched 55 and then bounced higher again, but that was quickly sold into, and it's now, well, once again, it's probably spent about 6 months below that 64 level, and each month it's bends below 64, reduces the probability of it getting back above, and you would have to say then favors another test of that 55 level. Wheat chart, we don't look at very often, but I thought we'd throw it in there just to show how since the Ukraine war began and we got that massive spike in prices, that has now largely dissipated and we're back down now at much more reasonable levels. And this across the other agricultural seems to be a similar story as well. So that's good news for food prices. On the copper, well, this is making all-time highs, all-time closing highs at least. Up above that, we seem to have recaptured that $465 per pound level that it had been flirting with in around here. And pushing higher, obviously, copper is in demand for the green tech revolution, if nothing else, but also lots of other things too. So it's always going to have bullish pressure on it. It's also got supply side issues as well, and that's both helping the price to the upside. And on iron ore, well, we are in this kind of very wide descending triangle. 100 has been the key level for iron ore. It's been above it, below it, above it, below it, and it's once again back above it. So it just seems to be very much sideways at the moment of the iron ore. Obviously caught up in the story of the Chinese slowdown at the moment, and it's certainly unlikely that we'll see those heady days of 140, 150 anytime soon once again. But always saving the best to last, and if you've been under a rock, you will certainly be unaware that gold hitting 4,000 has been the big news of this week in particular. And this year, if you like, it's been a meteoric rise of gold, and there's all sorts of reasons for it, which there's no point in getting into here. But certainly on a technical basis, it's just looks unstoppable. It's gone parabolic. The bars are getting bigger as that volatility increases. It's likely that when this eventually tops, that it's not going to just go sideways like it did back here. It's much more likely we're going to get a very deep correction. So just be on guard for that if you are holding the shiny metal at the moment. So just to summarize that, US stocks making new all-time highs by the day. But are we just seeing a little chink in the armor or some storm clouds gathering? If you forgive me mixing my metaphors, it does look like there's just a few things we're seeing the market breadth starting to decrease, and a couple of other signs that things might not be as healthy as they once were. And that correction is coming, but how far away is it? We do not know. And the Aussie 200, well, it's flirting with that 9,000 level. Can we see a break above that? 10,000 would be a very, very key psychological level if it could get anywhere close to that on this occasion. On the currencies, story is very much on a weakening US dollar. That's helping the other majors, but we're also seeing Bitcoin make those new all-time highs. And on the commodities, well, oil and iron ore looking a little bit weaker. Copper's starting to look much more bullish, and we're seeing gold head off towards the moon. Thank you very much for your time. I wish you good luck, good trading for the next quarter, and bye for now.